financial and management accounting. We have started in the last class. We have discussed about certain topics. We discussed the definitions of accounting. We talked about bookkeeping. We went to some terminologies related to accounting. Now, to continue that, they will start with some basic terms in accounting, and there are accounting is when we talk about certain subjects or certain fields or areas, there are certain language which is being used. So there is the terms and conditions which are dedicated to that particular area, or we can say that particular field. Now, similarly, accounting also has got some terminology which is related to accounting, which may be used in general senses at times, but more or less when we call in accounting, they have a particular meaning with that. So when we say transaction, so that is to start with, the first thing is transaction. So when we say transaction is any event or any, let's say transaction is any event which has taken place. Let's say you bought up goods, or you sold some goods, you paid a salary, so you paid wages. Any amount of event which has taken place, that can be considered as transaction, right? We move next. We talk about capital. Capital, we say that it is any amount which is invested into the business. So any amount which is invested into the business, we call it capital. So it can be a long-term capital, it can be a short-term capital, depending on the money which is invested into the business. We move next and we talk about share. And when we talk about share in normal sense, we say that it's a part which is related to a certain person or somebody. But when we talk about shares and related to accounting, it is related to the ownership into the company, right? So the capital of the company is actually divided into small units of small denominations, and these units of small denominations are called as shares. So anybody that these shares are being traded onto the stock exchanges of the respective countries. So these companies, they have their stocks listed on exchanges and those are being traded. So when we call them stock or we call them share, it's the one and the same thing. We move to assets. And when we talk about assets is something where the organization has a legal right upon. So it can be a mine where they operate, it can be a land, it can be a building, it can be a vehicle that organization owns, it can be a livestock which they have bought. So there can be any asset, anything on which the organization has a right, that is an asset for that organization. Now these assets are further classified into a category, and where we call it current assets. And when we talk about current assets, we say that current assets are all those assets which are actually convertible to cash or cash balance. So there's a criteria, there's a 3-step criteria which applies on current assets, which says that current assets are those assets which are either a cash or bank balance. Second criteria, this was the first criteria. Second criteria, which is convertible to cash or bank balance. So something either a cash or bank balance, or something which is not a cash or bank balance, but yes, it is convertible to cash or bank balance within an year or an operating cycle, whichever is longer. The third criteria. So we had the first one, that it is either cash or bank balance. Second, it is convertible to cash or bank balance within an year or an operating cycle, whichever is longer. And the third one, that it is consumed in the operations of business. As we talk about raw material, so raw material is something which is consumed in the operations of business. So after a certain time, the raw material loses its existence and gets converted into finished goods. So that's where we have the third criteria, that is it's consumed into the operations of business. So please remember, when it comes to current assets, so it is either a cash or bank balance, convertible to cash or bank balance within an year or an operating cycle, whichever is longer. And the third and the last one, it is consumed into the operations of business. We move next, and when we talk about liquid assets, there's a concept which is at times comes again and again in accounting, and we call it liquidity. Liquidity, in the simplest sense, we can say it is the ability of an asset to be converted into cash. So we say that cash is the most liquid asset, something which can be used to pay off. So we say that cash is the most liquid assets, and the ability of the asset to get convert into the cash is its liquidity. Right? So when we say that stock is more liquidable than the fixed assets, than your machinery, than your land, than your building, so that's what we say. So the point is, when we talk about liquid assets are those assets which are convertible to cash easily. So we go in a different the order is that it starts from cash balance, what we have in hand, then we have a bank balance, then it goes to the debtors, then it goes to the stock, then prepaid expenses and all those things. So these are basically considered as liquid assets, the assets which are convertible to cash or can be converted to cash in near future or immediate future, right? We move next, and then we have, moving further, when we talk about next terminologies, we have liability. So as the asset was something which we own, liability is something which we owe, which we have to pay to somebody, which is due to somebody. That is liability. Again, the liability can be a short-term liability, can be a long-term liability. Now, if the liability has to be repaid in an year, 1 year is the time that I have to pay this liability, then that liability is called a current liability. So I have a liability. If that liability has to be repaid within a year, I'll call that liability a current liability. We move next and we talk about equity. So what is equity? Equity is kind of, we can say, the stake which the owners have into the business. So like we say shareholders equity. So shareholders, they have the stake into the business and we call it shareholders equity. So equity is the what is left after giving to everyone. That is what is equity. Then we talk about entity. We will talk about this concept later on in great detail, but yes, when we talk about entity is something which is considered as a individual, we can say, organization, or it refers to a business, it refers to a particular we can say business settlement. That's what entity is. So we use that, and we use entity for those particular business setups or organizations, companies, sole proprietorships, what we deal in. We move next, then we talk about sole trader. Sole trader is a type of a business when an individual starts his own business without taking anybody as a partner, not including anybody into the ownership or decision making. When individual starts business at his own and he himself takes care of everything, right? So what decisions needs to be taken, from where to brought money, what needs to be done next, everything when he decides at his own, that is what is called as sole tradership, and that person is called sole trader because he is the only person who is responsible, who is the owner, who is taking care of that particular business. We move next, and when we move to partnership, when two or more persons, they come in together. So I have, let's say, two or more persons, they come in together to start a business and to share the profits of the business in a ratio whichever what they decide. That is actually called partnership. So when you have somebody else comes in your business, and now it's like earlier it was single person, now it's more than one, that is called as partnership. So two or more persons, they come in together, join hands for a business to share the profits of the business. That is called partnership. Moving further, when we move from partnership, we have the next type of organization which we call as joint stock company. So the company which has issued shares to the public. So the company which has its shares trading into the public, or which has been floated into the market, we say open market, that is called joint stock company. That was related to the types of businesses we can say as well. But yes, it's sole trader, single owner, partnership, multiple owners, more than one, joint stock company, and number of owners, right? So it's something more than the partnership. We move next, and then we talk about goods. And when we talk about goods are related to the business what we deal in. So let's say if I have a medical shop, the medicines I deal in, that can be called as goods. If I have a furniture shop, the furniture what I deal in, that can be called as goods. If I have a the stationery shop, the books and the stationery what I deal in, that can be called as goods. Now, related to goods, we can have four things related to goods. So the first one is like purchases. So when I buy something, I call it purchases. So when I'm buying, let's say I'm a furniture dealer and I have a furniture showroom and I buy furniture to resale. So that is my purchases. When I sell that furniture to the consumer or to the person who bought that furniture from me, I call it sales. So I have purchases, I have sales. Then I have returns. So what happens? Let's say I bought some furniture or some raw material from a certain seller, and I was not happy with the quality of that. I thought, that this is not something which I wanted. I wanted to have something else, but I've got something else. So what should I do now? So what will I do? What any of us will do? Will actually go and return that to the seller. That is actually called as purchase return. So what I purchased, I returned that. It was not up to my quality, or maybe it came late. I bought it from somewhere else, whatever the reason was. But yes, it was something which I don't wanted, I didn't like, and I can return it. That is purchase return. Similarly, I have somebody might not like what I have sold to him, or there might be a defect, there might be some problem, there might be some issues with what I have sold. So that person, what he will do what I did when I didn't like it. He'll return it back to me. But for me, it will be sales return because I have sold it. So when I purchase and I don't like that purchase and I return it, I call it purchase return. When I sell and the buyer, whom I have sold, he doesn't like it, that is called as sales return. Now, every business, if it is not its first year, every business will have something as his stock when the business closes in, right? So let's say we have financial years from 1st April to 31st March. We have financial years from 1st of January to 31st of December. So every financial year, when we begin with this financial year, it has ended a day before, right? So if it's 1st of April, 31st March, it ends. If it's 1st of January, 31st December, it ends. So there's some stock which every organization is left with until and unless they are very good in managing their stocks, or they are too good in managing their stocks, they are left with some stock. So the stock, what they're left with on the closing of a year, that stock is called closing stock. We call it closing stock. Now I just took an example of an year, but this can be let's say I want to have a 6 months closing. So I want to know at the end of 6 months, whatever stock I had, that was my closing stock. I can have a month's closing as well. So every organization does that. So they figure out, that what was the stock I had on 31st of January and what stock we opened on 1st of Feb. So that also happens. So it depends on the period what you are choosing. And on the basis of that period, the last date of the period will be you will have your closing stock. Similarly, on the first day of the same period, you will have your opening stock. So if my firm, let's say if my accounting year is from 1st of January to 31st of December, and on 31st of December, I'm closing my business, right? So let's say my accounting year is getting closed, and on 1st of January, I'll have the new year start, right? So on 31st of December, I'll have some closing stock, and that closing stock will become my opening stock on 1st of January, the next day for the next year. So what I am closing today becomes the opening of my next year, we can say, becomes the opening of my next day, right? Similarly, we have inventories. So when we talk about inventory, we say stock, we say goods. So inventory is the stock what we have. And when we say inventory, so inventories again we can have there's a difference, So there are manufacturers and there are wholesalers. So if there are manufacturers, they will have three types of inventories with them. They will have raw material on that which they need to work upon. Then they will have WIP, that is work in progress, which is neither a raw material nor a finished goods. It is lying in between of these two. And the last one is finished goods. So we have inventory for the manufacturer. We can say yes, it's a raw material, work in progress, and finished goods. But when it comes for the merchandiser, right? So the merchandiser has only one type of inventory. He has only finished goods because he's not producing, right? He's not producing. He is only buying and selling, but he's not producing. So for the manufacturer, yes, we'll have raw materials inventory, we'll have WIP inventory, and we'll have finished goods inventory. But for merchandiser, we'll have only one type of inventory, and that is only finished goods inventory. We move next, and when we move to drawings. Drawings is a term which is used more in related to the sole proprietorship firms or the partnership firm, where the partner or a sole proprietor takes out money from the business for its personal use. So a sole trader, there was a sole proprietor. He has to give some gift to his wife, so he wanted to buy some jewelry. So he got some money from the office and gifted that jewelry to his wife. So that is something which is the amount was withdrawn from office. It was not in personal amount. So that's where that is considered as drawings. So that money which is withdrawn from the official cash or from official amount for the personal use, we call it drawing. We move next, and when we move to an important term which is called as debtor. And people often get confused with debtor and creditors in this accounting terminology. So I would request you all to pay special attention to this, please. So when you talk about debtors, right? Debtors is something where from whom I have to take money, right? So somebody, let's say I gave somebody $100,000, right? Or let's say $1,000. So that $1,000 he has taken from me. So I have given him. So he is my debtor now, because he needs to repay it back to me. I'm supposed to get it back from him. That is debtor. So from whom we have to take, we call them debtor, right? So from whom we have to take money, we call them debtor. So when you talk about debtors, right? So there are different types of debtors that exist into the business. The first one is trade debtor. And when we talk about trade debtor, as the name suggests, it is debtor related to the trade. So the trade I do, the business I am in, there is some debtor involved into that. So I sold some goods to somebody and he has not paid me at that point of time because it was not a cash sales, it was a credit sales. And whenever I do a credit sale, I create a debtor. So every credit sale leads to a debtor. So, but if it's like, that same person is coming up again and again and buying on credit, fine, the credit debtor will be one, but again the amount will keep on increasing. So whenever I do a credit sale, debtor is someone who is there, who exists, who actually it gives rise to a debtor, right? We can understand it something like this. Then we have a loan debtor. So somebody who has taken a loan from you. So somebody borrowed, right? So I give an example of somebody who took $1,000 from me. That's a loan. So that's a loan debtor. So we can have a loan debtor as well into the business. Then we have assets sold. So assets which are sold. So I have sold a machinery or I have sold a furniture. I have sold. I had a car which was 20 years old. I just thought that I should better sell it. I sold it, and the person is not paid. That is again, he would be my debtor, of course, because yes, I need to take money from him. But yes, he will be again the debtor based on assets sold. We move next, and then we didn't do any trade. We didn't give any loan. We didn't sold any asset, but we provided a service. So let's say we provided a service. The service could be anything. It can be a tuition service. It can be a repairing service. It can be any maintenance service. So we provided that, and the person has not paid. So he is a person based on, he's a debtor based on service. So he's my service debtor. Right. We move next, and we talk about debts. So debt is, if I'll say the plural of debtors, if I can say that if I have to collectively, give a term to all those debtors, fine, I'll say debt. So what is my total debt? right? So how many people are actually who are supposed to give me back? Now debt again has a problem. That can be used in both the sense. It can be like what you have to pay or what you have to receive. So the point is that we need to be very careful the situation, the context in which the word is being used, right? Debt. So when you talk about debt, it can be a good, bad, or doubtful debt. So when we talk about good debt is that a particular those debtors which we are very comfortable with find that they will pay up. They will pay on time, no problem. So that is your good debt. You're not worried, you're not concerned, you're very happy that fine, I've sold this person on credit, or this much amount is due from this person, but fine, yes, he'll pay me in time. I need not worry about that, right? So that's a good debt, right? I move further and I talk about something which is called as doubtful. Doubtful is something it was which is kind of suspicious, which is creating some kind of a doubt in my mind that I don't know I'm able to get this money back or not. So I have no idea. So there's some problems are coming up. Maybe the business has gone down. Maybe the person has been hit by COVID or something else has happened. But my money was at stake, and now there's a situation which is suspicious. That person will pay back or not. I have a concern about that, and the concern will only be get over when either he will pay or he'll not pay, right? And then finally something which is called as bad debts. So it is like someone was the good debts gets converted into doubtful, and then doubtful which doesn't comes up gets converted into bad debts. So that's how it works. So I have a good debt, I have a bad debt, and I have a doubtful debt. So we have always we call it debt. So the b, though of course b is there, but we always call it debt. B is always silent in these cases, right? Fine, so we move next. And when we talk about next terminologies, we have creditors. Totally, it's like exactly opposite to debtors. Exactly 100% opposite. So I say that debtor is somebody from whom I have to receive, right? From whom I have to receive. But creditor is someone whom I have to pay. So if I can sell on credit, I can buy on credit as well. Right. So if when I sell on credit, there's a debtor, I contribute to a debtor or the debtor increases. But when I buy on credit, my creditor increases. And similarly, I can have a creditor again in four categories. So it can be a trade creditor from whom I bought certain stuff or certain goods, but I haven't paid him. It's still due. The amount he has not got that amount, though he has sold it. I have received the goods, everything has happened, but yes, I have not paid the amount till now. So that is a trade creditor. Then again, loan creditor. I went to a bank and I asked them, fine, give me this much of amount as loan, and I'll repay you in this much time. That and this would be my installments. Fine, the bank agreed. They liked my business plan, they loved it, and then they offered me some money. But what I did, I took a loan, but I made a bank my creditor. So that's a loan creditor. So bank is now my loan creditor, and I need to repay bank that money which I borrowed from them in a maybe whatever installments in a time period what we have decided. Right. Then I have an asset creditor. Now asset creditor is someone from whom I have bought an asset. I have bought a latest machinery for my business. I mean excellent stuff, will create great quality of material. But I haven't paid for it. So if I haven't paid for it, that is something again, it's a creditor, but it is an asset based creditor. Then I have expenses. And when we talk about expenses are that money, that amount which were supposed to pay, but we have not paid it. So let's say you had a salary which you had to pay on the last day of the month. You didn't pay it. That's your creditor based on expenses. There were some wages which you were supposed to pay. You didn't pay it, right? So there were these are called expense creditors related to expenses. We move next, and when we talk about loss is something which nobody.
Prof, sorry for disturbance. Prof, can you just reshare your screen?
I'll do.
Thanks.
Is it okay now?
Yeah, continue, Prof.
Thanks. So that was related to creditors, right? Now when we move to the loss, so loss is something which nobody would like to, I mean, nobody loves, right? So I doubt you'll find anybody in this life who love losses. So nobody loves losses. So loss is something where, I got less so than what I expected or what I incurred the cost. So like, let's say I built a certain product, and that product costed me $5,000, but I didn't get $5,000 for that. I got when I sold it into the market, I got $4,000. So I incurred a loss. So something I have to pay out from my pocket. So that is loss. So it's like the owner or the business promoters, they have to bear it from their own pocket. That is something which is called as loss. Or we were not able to cover our expenses, meet our expenses which we incurred, and we ended up paying out from our pocket. That is what we can call as loss. Then we move to the profit. So what is profit? Profit is totally opposite to loss. And again, I believe we all, profit is something which we all appreciate. So profit is where you get more than your cost. So the same stuff, which we just took an example. So the same stuff which costed $5,000 earlier, I sold it for 4,000. So that's why there was a loss of $1,000. Now I sold it for 7,000. So I didn't. I had a new deal and I sold it for 7,000. And when I sold it for 7,000, I had a profit. So I had a profit of $2,000, right? So that's it. That makes the difference. So profit is when I recover more amount than the whatever cost I have incurred on that stuff or on that product. And the loss is when I recover less amount than whatever money I have incurred on that particular product or stuff, right? Then we get from the general understanding, we move to the more deeper into accounting, and we talk about accounting. In accounting terminology, there is something which is called as journal, right? So it's a journal, and when we call journal is a book, we can say, or journal is a name for where we actually record all the transactions. So it's kind of a primary book which is there. So anything which happens, any event, we discussed about transactions on the first slide, if you guys remember. So any transaction which happens, it's recorded into the journal first. So if I did some sales, I did some purchases, I bought furniture, I paid some salaries, I paid rent, I paid wages for my factory workers, whatever it is, that everything will be primarily recorded into the journal. I mean, we can say the journal books, or it's related to the books of accounting. Then you move to the ledger. Ledger is where you have individual accounts for every, we can say, heading. So let's say you did sales, so you had a sales account. So we call that sales account as a ledger account for sales. Then you have let's say you had a cash account, so that is again ledger account of cash. So ledger accounts, we can say these are individual accounts related to the particular groups or particular subgroups, right? So let's say you sold your goods to Mr. X. So now once you have sold it to Mr. X on credit, now Mr. X is your debtor, all right? As we just discussed, right? So Mr. X is your debtor. So if Mr. X is your debtor, you will have an account for Mr. X as well. So that is what is called as ledger. We call it ledger. Then we have entry. So entry is the first recording into the journal. We call it entry. So we say accounting entries. So that is what it is related to. So the first recording of the event, what we do in journal, we call that entry. So let's say I bought some goods for cash, right? So I'll write down something like purchases to cash. So that is something which is called as entry, right? We move next, and then we have something called as narration. Narration is the summary of that entry. So as we just took an example of purchases, when I purchased some goods for cash and we wrote purchases account debit to cash. So the narration is something which will describe this, that fine, goods purchased, let's say worth rupees 50,000 on this and this date. So that's what the narration is. So we can write it. It's basically related to very basic accounting, but yes, for a student, this is something which is important to understand. Then we come to the postings. So you have our journal entries, then those journal entries are being posted. So they are posted to their different ledger accounts. So this process is called as posting. So it happens, something which happens automatically in the softwares. But yes, for knowing and for knowledge purposes, it's better to understand that the process where journal entries get transferred or get posted to their respective ledger accounts, we call it posting, right? Then we have something which is known as voucher. So voucher is like the hard copy of the event which has taken place. So maybe it's a kind of a proof, right? It's a kind of a support evidence. That's fine. So let's say somebody says I did sales. So if I go as a, if I have to reconcile, or if I have some doubt, I would like to see where the sales are. Where's the document? And if I found that document, supporting document, I'll be glad, I'll be happy, fine, it's okay, nothing, no problems from my side. But if I don't find it, that's the problem, right? So voucher is something which supports that. It's a kind of a supportive document for whatever transactions we have done, for whatever events which have taken place, right? We move next. We move to the trial balance. Trial balance is again, it's a kind of a statement which shows us the balance of different assets and liabilities. So what is the balance of assets and liabilities on a particular date, that is being shown and shared by the trial balance. Then we have something which is the most wonderful, we can say statement of finance, that is balance sheet. So balance sheet actually shows us that what is the state of business, what or how many assets do I have, how many liabilities do we have on this particular point of time. So as on 31st of December 2020, what all assets I had, what all liabilities I had, how much debtors do I had, what cash balance did I have, how much creditors were there, how much loan was there. So all these details related to business are being presented and communicated in a document or in a statement which is called as balance sheet. We move next. And then we talk about something which is called as carried forward or carried down. And when we talk about carried forward or carried down, it is the closing balance of the ledger accounts. So when the ledger accounts, they have a balance, right? So the balance, I tell you how. Let's say you sold goods worth rupees 100,000 to Mr. X, right? You sold goods worth rupees 100,000 to Mr. X. Mr. X could pay you 80,000 out of that, but he didn't pay you the remaining 20,000. So that remaining 20,000 is your balance, is your closing balance. So that closing balance, we call it carried forward or carried down. So this is the closing balance which has come from Mr. X account, which he has not paid us. So he has paid us 80,000 out of 100,000, but no 20,000 still left. So that is closing balance. Now suppose we closed this Mr. X account, and then this Mr. X account needs to be opened in next period. So the opening balance will show that there was 20,000 which was closed, right? So 20,000 was closing balance, which has come up as an opening balance. So when that 20,000 which was carried forward will be transferred to next period, we call it brought forward or brought down. As the name suggests, brought forward from where? From the last period, from the last duration. Then we have bills of exchange. So bills of exchange is like something like an agreement between a seller and a buyer, that fine, where he promises that fine, I'll pay you this much of amount on this and this of date. So that's the kind of a written document which takes place between the buyer and a seller, and then that is legal, becomes a legal document, right? Similarly, the bills of exchange can be divided into two categories, that is bills payable and bills receivable. When it comes to bills payable is like simply like your creditors. So it's like when your credit whom we have to pay. So the bills which we have to pay, which we have to meet, which are due to us, that is bills payable. And bills receivable, which bills those we have to receive, which we are supposed to take money from, that is bills receivable. We move further. we discussed about posting, and I told you that posting is basically the respective entries are being posted into their ledger accounts, right? So simply we have ledgers. So ledgers are again the individual accounts related to the different groups or subgroups what we have. We talked about entry. So entry is the journal entry what we had into the primary books. So we can have anything what I do, purchase, sales, that is called as, and when I record it into the primary book, I call it as an entry, right? So that's how we end with the first unit, and I hope what we covered, we learned about the accounting and its process. We talked about different types of accounting users, concepts of introducing, and we learned about the basic terminology related to accounting. Here I end with the first unit. I'll share the next set of slides that will be related to second unit, and we'll just start with that within a minute or so. So just hold on for the time being, have patience. I'll just share the next set of slides with us. Fine. So after finishing with the first unit, where we learned about basics of accounting, we understood, we tried to have hands upon some basic terminologies, the difference between accounting and bookkeeping, what accounting is, what bookkeeping is. We moved to the more, we move more into the subject, and when we'll talk about financial accounting concepts, principles, bases, and policies. So when we talk about the concepts, principles, bases, and policies, we should be very clear with the first thing, which I would like to state over here only, that accounting is something which has been developed with time. So it started from the basic primitive age where people used to count and where people used to keep in records of how many things are there with us, how many things have gone out. With time, this has developed as a practice, and the different learners and thinkers, they have contributed for the development of accounting. Right? So with this background, we'll see how what all developments have taken place and how this particular concepts have come up and what all concepts are there. We'll have a look into those in details into the coming slides now. When we say accounting, so as I told you, it has evolved as an art of recording, classifying, and summarizing in a significant manner based on accounting concepts, principles, bases, and policies. There are certain rules, certain guidelines, set of concepts and conventions, certain policies which actually guide accounting. So it's not like that anything, we can record anything the way we want, or we can do whatever we wish or we like. No, that's not done. So it is something which follows certain set of rules and criterias, and then we'll look into all those in detail, right? So what we'll focus upon, we'll look onto the meaning of gap and enumerate its components in this session, in this unit. We'll define the accounting concepts, principles, policies, and standards. We'll go through the different accounting concepts and principles and the implications they have on the financial statements. Then we'll describe the major considerations which govern the accounting policies. We'll learn about accounting standards. We'll define the scope and functions of accounting standard. And we'll end up this unit, we'll finish off this unit at IFRS, that is the meaning and objectives of IFRS. To start with, if you look at the meaning, so accounting, as I told you, it's a practice which is developed based on certain concepts and policies, and these policies and concepts or principles are being followed globally to provide uniformity to accounting information. So I hope many of you would be aware about the things like GAAP, that is generally accepted accounting principles, IFRS, accounting standards. So they all prevail. Just different countries have their own accounting standards and their own gaps. So we'll look into it, and then we'll try to understand how it can help us. So if you look onto the features, yes, it follows certain concepts. It is based on certain principles and policies. We are talking about accounting here, and the objective of accounting is to provide true, fair, and comparable information to its users. That's the main thing which we should keep in mind whenever we are working on accounting or when we are working on, any accounting project. Moving next. So what is GAAP? That is generally accepted accounting principles. So we say it's a technical concept that describes the basic rules, concepts, conventions, and procedures that represent accounting practices at a particular time. So a gap is a kind of it's a document, right? If I tell you in very brief, it's a document which states the basic rules and concepts which you are supposed to follow, right? For a particular, we can say for a particular field. Let's say it maybe can be for a depreciation, it can be for inventory valuation, it can be for mergers and acquisitions of an organization. So there can be different gaps related to different we can say fields or different areas of accounting. Now, as we say, it is related to accounting principles, right? So when we say accounting principles, they are the basic rules of actions, and they are adopted by the accountants while recording accounting transactions and in preparing and presenting financial statements. So we follow GAAP for preparing and presenting our financial statements. And the country where you are, every country has its own GAAP. So it depends where all the organization reports, they have to prepare their accounting statements based on those particular accounting standards. So these accounting principles, they are accepted universally by accountants, professional accounting bodies, and business entities across the world. So that's how these accounting principles are accepted everywhere around the world. Move next. And when we talk about the components of GAAP, the GAAP there are two things which led to the, which impact GAAP or which are a part of GAAP. So we can say there are accounting concepts and there are accounting conventions. And people often get confused with this accounting concepts and accounting conventions. So I will request you all to pay more attention over here in these particular fields, right? So when we talk about accounting concepts, right? So we say these are the foundations of the accounting, right? So these concepts are assumptions which are generally accepted and followed while performing the recording of transactions and preparation of final accounts. So these are kind of we can say, the accounting concepts are something which is foundation of the accounting, right? And these concepts are generally accepted and followed. So what does it mean, or where do they help? They help in conveying the financial information in same meaning. So I can convey the financial information in same meaning based on the accounting concepts. So the accounting concepts is something which is being accepted universally and which is being taken care while preparing accounts everywhere across the globe. Right? And it helps in selecting appropriate method. So accounting concepts helps an accountant or helps an organization in selecting the appropriate method for its use or for the further processing. Then we go to the accounting conventions, and when we talk about conventions, we say conventions are the guidelines based upon custom or usage or general agreement. So conventions are something which has come up with a practice. So it is, if you can read between the lines, it says it's based upon customs or usage or general agreement. So the conventions are used while maintaining the financial statements by the common consent of accountants. So that's where the conventions are. So you use it while maintaining the financial accountants with the common consent of the accountants. So what we can figure out from this, we can say that the personal judgment plays an important role in case of conventions. But yes, it is not, again, we cannot say that it's illogical. There is a logic behind the usage of conventions while preparing accounting information. Coming on to next, something which is very important and which we should know. So what is the difference between accounting concepts and conventions, right? So they both look alike, but they are not. So conventions and concepts, they differ. So let's try to understand them in a better way with these particular details what we have, all the differences. So when we talk about meaning, we have an accounting concept. So accounting concepts, it refers to the rules of accounting which are to be followed while recording business transactions and preparing final accounts. I repeat again, it refers to the rule of accounting which are to be followed. We move to accounting conventions. Accounting conventions implies the customs or practices that are widely accepted by the accounting bodies and are adopted by the firm to work as a guide in the preparation of final accounts. So they are kind of a practice or the customs which are widely accepted, right? But they are not rules, right? So rules is something different. I mean, and the practice which has come something which has evolved with the practice, that is something different, right? We move next, and when we talk about, again on the basis comparison of this, we say, so what is accounting concept? It's a theoretical notion. Accounting convention, it's a method or procedure. Who sets accounting concepts? Is the accounting bodies who sets accounting concepts, right? So every country has its own accounting bodies, so they define, they finalize the accounting concepts. Then we have common accounting practices, that is accounting conventions, right? So is any biasness or any human judgment possible in accounting concepts? No, that's not possible. But is it possible in accounting conventions? Yes, it is possible. There is a scope. We move next, and when we talk about accounting concepts, there are basically 5 types of accounting concepts which exist. So if you look onto these accounting concepts, the first one, and the very important one, because all accounting starts from here, that is separate entity concept. The separate entity concept states that business and businessmen are 2 separate entities. They are 2 separate set of entities. We cannot mix them. So if I have a business and I have a businessman, I'll consider them as 2 separate entities. And this is the reason why the money which is invested by the businessman into business is considered as a liability by the business. So whatever money a businessman invests into the business consider that as a liability. That we always show that as a liability, because of this particular concept which says separate entity concept. We cannot mix both of them. The assets and liabilities of business are different. The assets and liabilities of business owner are different, right? Then we move next, and when we talk about going concern concept, going concern concept, in the easiest line or easiest way to understand, it says that the owners may come and go, but the business will go on forever. So when we prepare accounts, or when we go for any business, or when we go for any transactions, we consider it in mind that the business will be there for forever. The business will not get closed. It will be long lasting. The generations may come, the generations may go, but the business will remain. That is what is going concern. So the accounting concepts this is the accounting concept which is being taken care of while preparing accounts. Next is money measurement concept. As the name suggests, all those transactions or all those events which can be measured in terms of money, that only can be recorded. So how loyal your staff is, how hardworking your people are, how good your team is, those all things are cannot be recorded in accounting. So anything which can be measured in terms of money, that can only be recorded. Then periodicity concept. Periodicity concept says that there has to be a certain period for which we need to prepare accounts. You cannot do it. Let's say if you have to prepare 5 years accounts together, you cannot do it. And even if you're able to do it, you will do a lot of mistakes into that. So periodicity concept says that fine, let's divide them into a particular period, and then it was decided that fine, the accounts have to prepare for annual accounts. That is, for every year we need to prepare accounts. So that is periodicity concept. So we need to prepare accounts annually for every organization. Ever think, I mean, I doubt you've ever come across an organization who has not prepared accounts for 2 years, 3 years, 4 years, and then they, prepared for 5 years altogether. No, not possible. Then we come to the accrual concept. The accrual concept is something where the accounting is based upon. Accrual concept says that it is even if you have not received money but you have sold, you can actually show that as your sales and can use that amount in calculating your income or your profit. That is accrual concept. So we say there's cash basis and there's accrual basis. So accrual basis is that only. So if you have sold and you have done the required, whatever was required to book your sales or book your profit, then yes, you can record that sales in your accounts and you can use that sales for calculating your profit. That is accrual concept. So no matter I have received the cash or I have not received the cash, but if I have sold and if I have done the requisite, I can record. Let me give a simple example. Right. So let's say you have a hotel and you had a party in your banquet, right? So there was a party of 500 guests who came, and the party was organized. Everything went well. The party got over. People went home back home. And now the year got closed, right? And you have not received money still. The money is due, so we can assume that it was a Christmas party, and your year closes on 31st of March. So 31st of December. Your year closes on 31st of December. So that 31st of December, by that time you didn't get your money. So will you show that as sales in your business or not? The accounting says yes, you can show that as sales in your business for that financial year, irrespective you have received the money or you have not received the money, because you have done what was requisite. You have done the requisite, you have done what was expected, you have rendered your services, you have all the rights to book it as your sales and can include that in calculating your profit. Right. We move next. Accounting concepts, we move to accounting conventions. And if we talk about accounting conventions, so the conventions are of 8 types, and the first one is convention of revenue recognition. Convention of revenue recognition says that you cannot book a revenue until unless you have done what was expected out of you to earn that revenue. We'll go back to the same example, the hotel where we had a party and banquet, right? 500 guests came. On 25th, you have that party. That's a Christmas party, right? And the customer paid you money, all money in advance on 23rd of December. So on 23rd, you had all the money with you. On 25th, you will have a party. Can you show it as sales, or can you include that money into your sales and for calculating profit on 23rd of December? No, you cannot do that, because you have not done what was required to earn that money. On 25th, once your party gets over, everything goes well, after that you can book that money into your sales and include that into your profit. So that's like something related to revenue recognition. So we say it's convention of revenue recognition, which says you cannot consider as a revenue, or you cannot consider any amount as a revenue until and unless you have done what was required to earn that money. Let's say you are required to pay, you have been provided in advance, right, for a next year's order. So can you book that as your revenue? No, you cannot do. It will be there in your books, but with a different heading, but not as revenue, because by next year when you will deliver that stuff and once you will done what was requisite, then only you can actually able to book it as your revenue. That is principle of revenue recognition. We move next and we talk about matching cost and revenue convention. So what is matching cost and revenue convention? Matching cost and revenue convention suggests that when you have a revenue and an expense, right? So whatever expense has been incurred for generating that revenue that should be matched with that revenue only. I'll explain. When you, let's say you produced a raw material, right? You converted a raw material into finished goods into into year 2020, right? But you are not able to sell that in year 2020, right? A certain stuff was left unsold. So that stuff, now you're able to sell it in 2021. Now when will you include the cost of that 2021 of that stuff into your books, or when you will show it? So because you will be selling it in 2021, you will be showing the cost also in 2021. That is matching concept. So the that is matching convention. So matching cost and revenue convention says that when you have the revenues, right? So whatever expenses you have incurred for earning that revenue should match that revenue, the year in which that revenue has been earned or has been recognized. Right. We move next. We talk about convention of historical cost. And when we talk about convention of historical cost says that all data needs to be recorded at a historical cost. So if you have bought a machinery 5 years back for $500,000, that machinery as a gross cost will still appear in your books as $500,000. Irrespective of the depreciation virtual charge, that will be a different story. That is altogether a different thing. But yes, the gross value of that machinery will be $500,000 in your books till now, if that machine is still there in your books. So that is historical cost. So all things are recorded at their historical cost, except some, we can say some exemptions, right? Then we have convention of full disclosure. So the convention of full disclosure suggests that you should not hide anything which is relevant and material for the people to take their decisions, or which can impact their decisions. So what is full disclosure? We can say that full disclosure is nothing should be hidden. You should not hide anything. Everything needs to be disclosed, right? So there's no scope of hiding. There's no scope of not showing everything. Full disclosure suggests that you should show true and fair picture of your business. Now that's the full disclosure. Move next, and when we talk about further conventions, we talk about convention of double aspect. So the convention of double aspect says that there is always a double impact, or we can say dual impact of every transaction. So if you are, let's say selling some goods, or if you're buying certain goods, so on one side, yes, you are buying goods, but on the other aspect, you are giving money out of your business as well. So the one way you are gaining that an asset is coming in your business, other way you are the money is going out. So there is again a dual impact, right? So maybe it depends, it can be on the liabilities, it can be on the asset side, it can be asset liabilities, both. That all depends, right? Then we move next, we talk about convention of materiality. And when we talk about convention of materiality is something which suggests that all those things, or all those information which is material, which is impactful, which has an impact, should be shared, should be disclosed. So, but this convention of materiality has some, we can say, it's subject to judgment. So because your materiality differs from business to business. For a business which has started with $100,000, for that business $5,000 or $5,000 are a big amount. It's like 5% of the total money. But for a business which has maybe started with $1 million, 5,000 rupees, or let's say $500 is something which will not be relevant to them. So that's where the materiality comes in, and it has a role. So, and it is subjective. So it all depends on the kind of the business you are dealing in, and the books, what is the value of your books, that is more important, right? When we talk about convention of consistency, so the convention of consistency says that you cannot, you're supposed to follow one policy or one rules and regulations. You cannot keep on changing them. That's fine. In 2020, I'll follow this rule. 2021, I'll move to another one. In 2022, I'll realize, no, this was also not good. I'll move to the earlier one. So that is something which is not done. So you cannot have a roller coaster ride like this, but you should have a consistent policies, same set of policies being followed by your organization, up, and in years to come, right? Then convention of conservatism or prudence. So the convention of conservatism or prudence, it suggests that anticipate no gains, but book for losses the moment you sense it. So the idea is that howsoever sure you are, right? You may be more than 100% sure regarding your profit, but please don't book it in your books of accounts. Don't include it. Don't say that fine, I've earned it. This is my profit. No, right? Unless you receive it, you have it in your hands, right? But the loss, the moment you smell, that fine, there can be a loss in this transaction. Start arranging for it. So that's the prudence. So when you have a profit, don't anticipate a profit, but when you can get an idea about a loss, please go ahead and start working on it. So that's a prudence. That's something which is conservatism. So any loss I'll start working upon it, I'll start making a provision for it. So, but any profit, no, I cannot do anything. I'll not book it. I'll not say, no, yes, I've earned it. No, that's not done. Right. We move next. And when we talk about, we move to accounting policies. So now accounting policies are basically the principles and methods of accounting which are adopted by enterprises while preparing and presenting the financial statements. And the management of each enterprise has to select accounting policies based on the nature and circumstances of their business. So there are policies which are based on the on certain accounting criteria, and then every organization need to select it as per their appropriateness of their business and the circumstances. So let's have a look at it, what all that can be. So these are the areas where we can have accounting policies which can be adopted. So like methods of depreciation, treatment of expenditure during construction, conversion or transaction of foreign currency, valuation of inventories, treatment of goodwill, valuation of investments, treatment of retirement benefits, recognition of profit, valuation of fixed assets, treatment of contingent liabilities. Right, so these are the areas. Then what they need to follow, or what actually they need to take care of while coming up with the accounting policies, that fine, these are the accounting policies which I need to follow. So yes, so the first thing is prudence. I hope you guys have got an idea about prudence. Prudence is that I'll anticipate no gain, but the moment I'll sense a loss, yes, I'll do arrangements for it. I'll start working on that, right? Then substance over form. Substance over form is that we can say that it is like I'll not go on to the type of event, but I'll go on to the importance of event. Is that event important? Is that something which is important for my business? Right? Does it hold relevance for my business and how it can be more valuable? So that is substance over form. And then I have a materiality. So materiality is like a cost benefit analysis. So I'll decide that fine, what should be shared, and is it relevant to share, or will it affect the decisions of investors, or we can say the decision makers, right? We move next, and when we talk about certain factors, so we recommend it on the, when we say that change about in accounting policies. So is change allowed? The answer is no. You cannot change your accounting policies. It's not a cakewalk that I'll change it the way I want. No. But yes, in some circumstances, when it's like when it is like in rare circumstances where you feel like that either the law has changed or the changes have to be done according to law, or it will lead to the better presentation or better, or you can say the more better view of your books of accounts, yes, you can change it, but you need to give a logical reason and justify this for changing, for why did you change, right? So that's the accounting policies. It can be changed if there is a statutory requirement and if there is a better presentation or better view of your books of accounts or your accounting information. Then what do we need to disclose in case of change in accounting policies? So yes, if I'm changing my accounting policies and it has a material effect in current period, right? So I'm changing it as a material effect in current period, and it is ascertainable that what impact it will have, right? So then in that case, I need to show the amount, the change, amount of change that needs to be disclosed. So what material impact it is having, how much is the amount, where the changes are, or how much impact it is taking as per the amount wise, that I need to disclose. If the change has a material effect in current period and the effect of change is not ascertainable, please keep it in mind. In the first point, it was ascertainable. In second point, it is not ascertainable. So it is not ascertainable wholly or in part. The fact should be disclosed. So what change you have done, that should be disclosed. That fine, we have done this change, and the effect is not ascertainable. That's why we cannot disclose the amount of effect. And if the change is no material effect in current period, but it is reasonably accepted to have a material effect in later periods, the fact of change should be appropriately disclosed. So the point is on how we can actually understand this. If you have done some change in the current period and the effect is ascertainable in current period, please show the amount. The amount needs to be disclosed. If you have done the change, but anyway you cannot either ascertain the amount or the impact is not there into this particular period, you need to disclose the fact. Right? So that's what needs to be disclosed in case of change in accounting policies. Then there are some disclosures which we call as mandatory and voluntary disclosures. So mandatory disclosures, they come from the statutory requirements, from the rules and regulations, from the governments, from statutory bodies. And then we have voluntary disclosures, which are over and above the mandatory disclosures, and we call them voluntary disclosures. Next, we talk about accounting standards. Right? So every organization has its own accounting standards, and when we talk about accounting standards, is a selected set of accounting policies or guidelines regarding the principles and methods to be chosen out of several alternatives. So the basic purpose, so why any organization or any country makes accounting standards, they do it to harmonize the accounting policies and practices. So we have accounting standards in every country, and they are being prepared, they are being done to harmonize the accounting policies and practices. The adoption of accounting standards ensures, so what it will ensure? So if you have an accounting standard, a set of rules and regulations which you are supposed to follow, so what it will ensure? It will ensure uniformity, comparability, and qualitative improvement. So there will be uniformity in the information would be comparable, and qualitative information in the preparation and presentation of financial statements. We move next. And how did it come up? So the accounting standards, they were actually different. There are different accounting standards with every country. So there's an attempt which is going on for harmonization of accounting practices, and it is going on at an international level. So the first, it was started with the ISC, that is International Accounting Standards Committee, and then this ISC was replaced by ISB, that is International Accounting Standards Board, in 2001. And most of the countries, they have their own accounting standards, we know. So in India, we have ICAI, and the ICAI established accounting standard boards in 1977. Then how does accounting standard board works? So it was constituted in 1977. We have gone through it. So the aim of this was to bring the uniformity among various accounting policies and practices that are practiced in India, to determine the broad areas in which accounting standards need to be formulated. So the board, actually, the accounting standard board, it holds a dialogue with the representatives of the government, industry, and other stakeholders to know their views, to get an idea about their views. And on the basis of these discussions which happen, the board prepares a draft proposal for comments by the members of the institute and the public. And after modification, a final draft is submitted to the council of the institute, and the accounting standard will then be issued under the authority of the council. And when we see council, it's Institute of Chartered Accountants of India. It's their council. Then coming next we have IFRS. So when we talk about IFRS, so these are international financial reporting standards. So the whole world is trying to come onto the one platform. So we have like the whole world is trying to um, we can say adopt the international financial reporting standards, that is IFRS. So these are the standards and interpretation and framework for the preparation and presentation of financial statements. So these are IASB is the body, that is International Accounting Standard Board, which issues IFRS. And then we have certain objectives of IFRS. Of course, it emphasizes on the quality, understandability, and global accounting standards, which for high quality and transparency. It actually emphasizes the use and rigorous application of those standards, that is IFRS, International Financial Reporting Standards. To fulfill the objectives associated, taking into account the special needs of small and medium entities and emerging economies. So IFRS is not related to the big companies only. They are trying to focus on the big and small companies and the emerging economies, and to bring about convergence of national accounting standards and IFRS to high quality solutions. So it's like merging is, the changing is happening, and the changes are like taking place. So different companies are converting their accounting standards on the basis of IFRS. Move next, then we talk about scope of IFRS. So all accounting standards and interpretations issued by the former IFC and Standard Interpretation Committee continue to be applicable unless and until they are amended or withdrawn. So IFRS applies to the general purpose financial statements and other financial reporting by profit-oriented entities, those engaged in commercial, industrial, financial, and other activities regardless of their legal form. Entities other than profit-oriented business entities may also find IFRS appropriate. General purpose financial statements are intended to meet the common needs of shareholders, creditors, employees, and the public at large for information about an entity's financial position, performance, and cash flows. Other financial reporting includes information provided outside financial statements that assists in the preparation, interpretation of complete set of financial statements, or improves users' ability to make efficient economic decisions. IFRS applies to individual company and consolidated financial statements. A complete set of financial statements include a balance sheet, income statement, cash flow, statement showing either all changes in equity or changes in equity other than those arising from investments, buy and distribution to owners, a summary of accounting policies, and explanatory notes. And if an IFRS allows both a benchmark and an allowed alternative treatment, financial statements may be described as conforming to IFRS, whichever treatment is followed. So these are all are actually the scopes related to IFRS. And in developing standards, ISB intends not to permit choices in accounting treatment. Further, ISB intends to consider choices in existing IAS with a view to reduce the number of those choices. IFRS will present fundamental principles in bold face type and other guidance in non-bold type paragraphs of both types of equal authority. And the provision of IAS 1 that conformity with IAS requires compliance with every applicable IAS and interpretation requires compliance with all IFRS. So this is what all for the day. I hope just repeat what all we have learned. We learned about accounting concepts and conventions. We discussed about the difference between accounting concepts and conventions in this class. We worked upon different accounting policies which are there, and then the concepts and scope of accounting standards. And at last, we finished off with the scope and objectives of IFRS.
Prof, I should thank you for the very elaborative and detailing session today. We have covered more topics, I believe. I hope all the participants have enjoyed it, understood it. That is more important. Before I get into the QA quickly, I just want to make one quick announcement because of the queries that are coming on the attendance part. I suggest to all the learners that they be engaged in reading through the content. The tutorials and the book, the e-book that is given in LMS is very elaborate with lot of explanation, examples, definitions, and you can usually understand from that. And then if you can attend the session, it makes most out of it, because Prof explanation was very good. And that reading of the book will also help you from the exam point of view, because most of the questions comes from the book. So you have to be engaged, and that is also the progress that comes from there is important from the attendance point of view. Your presence in the session plus your engagement through adoption of the content through the LMS is more important for the learning, from the knowledge point of view as well as from exam point of view. Right? Prof, I'll quickly go through the questions. It was a very extended session today. A lot of questions are there. And before I make one more, before I get into the questions, I request all the learners to make a very detailed participation through discussion boards with illustrations, so that also will get answered by the faculty and the mentors shortly. Your mentors will be connected with you in the coming days, and they will start engaging you. Okay, Prof, stocks of company is asset of the company or liability?
Great question to take care of. I would like to clear off. I mean, is it the stocks? I believe when the question is asked in reference to the shares, right? So the share capital or the stocks, which are that. So in case of company, as we discussed about the separate entity, right, concept. So the stocks for the company are considered as a liability for the company. So it's an investment for the person who has bought it. So somebody who has bought the stocks, it's an investment for him. But for the company, yes, the stocks are a liability.
Okay. I'll move on to the next question. Current assets and liquid assets, if you can just broadly classify.
Sure. See, current assets can be a part of liquid assets for sure. Current assets are they are based on certain parameters. So when we talk about liquid assets are something which is, we can say, more either cash or bank balance or convertible to cash or bank balance. I take it to an example, when we actually do a company analysis. So we work on certain things related to where we actually ask for, to calculate certain ratios. So when it comes to the liquidity of the company, when we move to the best parameter, we talk about three things only. That is cash in hand, cash at bank, and the cash equivalents what I have, and the marketable securities. So these are something which can be considered as we can say more liquid. In other words, I'll say all assets are, we can say, they have a liquidity, but the liquidity parameter differs. So something like machine or a fixed asset or like a plant would have a, will take lot more time in converting to cash. But something like a shares or stock I have or a short-term investment I've done in a certain company will take far lesser time to be converted into cash. So that's how we can make a parameter and we can decide, related to the liquid assets and current assets.
Okay. Thanks, Prof. Limited liability company, if you can just explain with an example, limited liability company.
Sure. Limited liability companies are those companies which have liability limited up to the extent of amount which has been, committed. So if you say, all these companies, we say, they have a limited in front of them. So let's say if you have bought 10 shares of a certain company and that shares have costed you, $1,000. So your liability is limited up to that $1,000. So no further, we can say, nobody can come and ask you more amount than that. So that is limited liability company. So it is either a private limited or a public limited. So in private limited, it's the owners who commit that fine. This is the amount we are committing. Further than this, will not be responsible. In public limited, it's the shareholders who commit that fine. This is I'm liable up to the amount of shares I have. Just further, I have no obligations towards this company. That is limited liability.
Okay, that's an interesting question. Promotional assets, is it considered fictitious?
I would like to have certain details on this. I mean, what does it, what the student mean by this promotional asset?
Yeah. So the question is whether they are questioning whether the promotional assets are considered fictitious. Maybe a bit more elaboration through discussion board will be more easy for us to answer.
Yes, because until unless I have no clarity that what promotional assets they are talking about, I cannot say anything. But just to answer, if it is related to, if you're talking about those expenses which are incurred before the company has started or before the company came into existence, yes, that can be called as fictitious assets. But if you are talking about promotional expenses which are related to advertisement and all, that we don't not considered as fictitious assets. That is not considered as fictitious.
Okay, thanks for the clarity. If trade debtors and service debtors, is there any big difference? Because practical terms, sales of products and sales of services all are trade.
That was here to just to make it more clarify. Otherwise, yes, you are perfectly fine. So whatever trade I am into, the debtor is a debtor, irrespective of the service or irrespective of the good. But just to have more clarity on this, we have distinguished it between the trade debtor and the service debtor.
Okay. Again, one basic question on journal and ledger. What's the difference?
Journal is, I'll say, that if we, I'll put it in this way, you let's say you have a warehouse, right, and you have let's say 10 trucks standing outside your gate to be offload, and you don't have time. So what you will do actually, you will just offload them at one place and let the trucks move out because they have to move first. So similarly, I have certain entries, they come up into my accounts and I put them into the journal in the first scope. So I put them in the journal and it is for the time being it is settled. Now these, after that, if I go back to my trucks example and warehouse, now the goods or whatever stuff I have offloaded, now that stuff needs to be classified into different warehouses or different groups. That fine, this belongs to, let's say, maybe this category, or this belongs to certain X category, this belongs to Z category. Similarly, ledger is that. Ledger is, once I have the entries with me, I can classify those entries into different subgroups or different heads. That is where the ledger comes into the role, and they have their own entries with that. So if I have to look for, let's say, if I have to look for what all purchases I have done, so I have two options. Either I go to journal and I search for all those purchases entry which I have done, or either I go straight away to ledger, purchase ledger, and see that fine, what all purchases have I done. Right. So
Okay.
that's where the difference comes.
Okay. What is postulates of accounting?
Postulates of accounting is it's simply the concept of accounting what we were discussing. So it's nothing more. It's one more term for the concept of accounting which we have discussed.
Okay. And the term GAAP, if you can bit elaborate on that. These are general accounting principles.
Yes, it's generally accepted accounting principles. We call it GAAP. So, like in US, we call it GAAP. In China, we have China GAAP. If you come to the India, we have Indian accounting standards. We don't call them GAAP. So that's a name which we are providing to the principles of accounting, which will follow in a particular area or a particular region. So that's what is generally accepted accounting principles are. So every country has their own accounting principles based on their traditions, customs, and practices, and based on that, and that's where we closed at IFRS, that the whole world is trying to come up on the one platform where the accounting records can be made based on one set of accounting principles, and that's where IFRS, they are trying to come up on the one platform, that is IFRS.
Right. When you touched upon the concept of accounting concept and accounting convention, so when does one go for accounting concept and when to choose accounting convention?
Great question. I believe it's when you have to go for the decisions like I'll say accounting based on separate entity, going concern. When you work upon like this, so let's say if you have to work on a machinery life, right? So you cannot say that you have to take certain assumption, right? That fine, this would be a machinery life, 5 years, 6 years, 10 years, whatever you decide. So at that time, you are focusing on the concept, that is, going concern. And when it comes to the convention is something when it comes to the, like, let's say you have bought a machinery, now what method you need to apply for depreciation on that, right? So that is like convention. So that's how you need to figure out between the concept and convention. So it starts with concepts, sorry. It starts with concepts, move to convention.
Thanks. We always used to hear from the finance people there's income and revenue recognition. So what is the basic difference between both?
Revenue is I'll say total sales. So my total sales is considered as revenue. So whatever I have sold, that's my revenue. But from that sales, if I deduct my expenses and come up with the balance of whatever left with, that is my income. So when I talk about income, it is kind of what I have earned. But when I talk about revenue and when I refer to revenue, it is like what I have sold, the total sales.
Yeah, that's right. Okay. What is prudence, Prof? You touched upon prudence, if you can explain.
Prudence is, if you go to the dictionary meaning of prudence is something which is called as cautious.
Yeah.
Being cautious. So prudence is like it's like that fine. You are not, if you are anticipating any profit or any gain, you will not record that because you never know that gain will turn around or will not turn around. Right. So it is basically related to like presenting true and fair view of your books of accounts or your business. So I may expect that I'll have a 10 crore profit after 2 days, but I cannot show it right now because if I show it, my accounts get inflated, and it may lead to an unfair picture, and I might not earn that. Right. But when it comes to the losses, if I anticipate that fine, I can have losses. So it is like the business works on agent-agency relationship, right? So principal-agent relationship, I'll rather say. So the moment I anticipate any loss, I need to have a provision for that, or I need to start working upon that, because if it comes up later on and I didn't work upon that, I'll miss two things. The first thing what I'll miss is that I failed in communicating that thing to my investors or to my decision makers or to the people who are the users of my accounting information. Second, the moment I didn't start working immediately on that, I let that problem to rose up more, or it may become, it may take more, it may get more severe. So that's what it is. So that's the two things which work in prudence.
Okay.
So better to consider it. It simply says, I mean, the first line it says that anticipate no gains, but the moment you have an idea about losses, start working for that. That's prudence.
Right, Prof. I'll take few more questions. What is substance over form?
Substance over form is like that you need to decide that do whatever I'm actually doing or whatever I'm working upon, is that worth sharing, or is that something which has an impact? So something may look like that fine, it is not very important, but that may have a huge impact. So, and something may look very big, but it might not have that huge impact. So that's something which is we need to work upon. So if I take it in simple examples, let's say you had a virus threat in your account in your IT or in your information system. So that is where you need to decide that needs to be shared or not. So it's a virus threat today, it looks small, but it reoccurs and it happens again and again. It may create a problem. Right, so we need not go on to the form of the problem or form of the concept. We should go on to the substance. That's how important is it for us. What impact it can lead to. That is more important.
Right. What are doctrines?
Doctrines are, we have certain terminologies which are used with for concepts and conventions only. So in certain countries we have the terminology changes. So there we use doctrine. So it's the same thing, but the term differs.
Right. Just the practical question: an order is received for the scale of sales of goods. Can it be considered as a realization of income just by receiving the order?
No.
Okay.
Until and unless you have not done what is requisite, we cannot consider it as recognized as the revenue.
Fine. So there's no income actually received from that as of now. Yeah.
We have not done
last
what was
question.
required to do, what we are supposed to do. So, like if I give the restaurant example, right? So until unless you have not, the party has not taken place, you have not delivered everything, you cannot book it as a revenue.
Right. Maybe one last question. What is the difference, big difference between current asset and liquid asset?
I believe we have discussed it. In case you want, I can come to it again.
Yeah, I just summarize it so that it will be useful. Yeah, it is detailed given in the learning material also.
Yes. See, when we talk about liquid assets, liquid assets are like we compare the assets on their convertibility to cash. So how readily or how fast they can be converted to cash. So if I have a cash in hand, cash in bank, that's the most liquid asset I have. Then I have accounts. Then I have any cash equivalent, any short-term investments. That is again the next thing. So as I said, that the assets can be rated on the parameter of liquidity. So it depends, which assets I'm talking about. If I'm talking about the most liquid assets, yes, the liquid assets are those assets which are readily convertible to cash or either cash or bank balance. And current assets, as I told you, current assets are basically those which are maybe either cash or bank balance or convertible to cash or bank balance within an year or operating cycle, whichever is longer, or which are actually consumed into the operations of business. So that is current assets. So that's how it differs. So these are like we are kind of a classifying assets on different parameters. That's how I'll put it.
So, Prof, thank you so much for your informative, elaborative session today. Hope to meet you again in the next session. I thank all the participants, learners who have joined this session today. Keep engaged with us, keep connected with us. Regarding assignments and exams, I'm getting some questions. Just want to answer that. Don't get just bogged down on this now. Enjoy the learning as of now. Assignments will be posted by the university sometime by end of the month or next month. You will be given ample time. Examinations will be online. It will be for 70 marks, completely online with MCQ and descriptive also. It will be very flexible, very easy. You will have experience of taking a mock exams before your actual exams to make it comfortable. So the most important part is the learning curve. It should be increasing. Every day should be learning. So ensure that there is a progress done every day. A lot of subject matter experts, videos are there. Go through it and go through the very elaborative content we have given chapter wise, right? So that will help you from learning the subject in detail, because we have given assessment questions also in there with a lot of examples, illustrations, and also it will help in the exam point of view. So thank you, stay connected with us and enjoy. I hope you all enjoyed the session. We will all meet tomorrow for the next session at sharp at 11 a.m. Thank you so much. Have a wonderful evening. Prof, with your permission and with information to all the learners, I am completing this session today. Thank you, one and all.
Thank you, sir. Thank you.